Well, good morning, everybody, and welcome back to those of you that were with us earlier today. This is the second session of 3 that we put together for today. Again, welcome. I see a lot of familiar names. Happy Saturday morning. I think this presentation is, it turned out to be better than I expected, and it's probably mislabeled. There's some pretty interesting moments in this one. We're basically going to be focusing in on the key success factors of, again, as we said before, 7 or 8 decades of the modern investment club movement in doing this. And this is not just in a presentation for clubs, and maybe that's where people get a little bit confused. You know, in our community, the vast majority of people are in some form of investment club, but I would basically say that the notions that we're going to be talking about here, it really is about portfolio design and management. That's why we stick it in that section. We're basically trying to talk about lessons learned, success achieved, key success factors, and all that kind of stuff. And all of this applies whether or not we're talking about a group of people gathered together to invest as a club, or whether it's just a bunch of people trying to take care of their own personal portfolios. Many of you already know the statistic that 90 to 95% of the members or partners of an investment club invest in their own brokerage accounts on the side. So, I mean, this literally applies to anybody and everybody, and we're going to be talking about managing portfolios. The picture of Snoopy and I forget the bird's name now, but Woodstock and Snoopy there around the campfire, that's been something that we've used for the last year or so. And it actually comes from a presentation made by Hugh McManus in our roundtable towards the middle of last year, where he talked about instincts and how our human primal instincts sometimes get in the way. You know, that very reliable feeling of fear that in some cases can save our lives, in other cases can actually be detrimental to us as long-term investors. And he wrapped the entire presentation in stories that had to do with cavemen, and somehow he wrapped Star Trek and Captain Kirk and Lieutenant Spock and all that kind of stuff into it. But what it really came down to is this notion of, you know, even going back to the days of the hunting and gathering cavemen, that they built campfires to keep the group of them collectively safe at night from the other predators that were out there. And I really think that there's a lot of corollaries to the investment club movement. And many of us who have been either in clubs or observed clubs, just this notion of reinforcement, positive reinforcement among friends and colleagues, and this notion of reinforcing patience, discipline, and all that kind of stuff. Almost all of those clubs center around taking care of a portfolio. And then, of course, on the far right, one of my favorite images ever, one of the first articles I wrote ever for Better Investing had to do with this notion of a barn raising, and basically people coming together to put together a barn somewhere. In fact, my wife is off doing that as we speak this morning here in the Pontiac area. So good stuff. All right, we're going to talk about some stocks and portfolios and all that kind of stuff. This is for educational purposes only. No investment recommendation is intended. Period. Well, let's just start with this notion of, again, as I said, this is not completely about investment clubs, but more the philosophy or the environment. What are investment clubs all about? And that famous shot with Linus from A Charlie Brown Christmas. You know, what are investment clubs all about? And here's at least one answer. They really are a long-term successful investing. That's what they're about. They're about learning by doing. They're not necessarily about the money. They could be groups of people contributing to a partnership, a common shared fund of $20 to $25, maybe $50 a month. Chances are outside the club, they're, as we said, 90 to 95% of them are investing in their own brokerage accounts. But it really is a learn by doing. But it's even more than that. It's this notion of being protective, being supportive. Don Danko, the retired editor of Better Investing magazine, used to talk about Weight Watchers and the power of, you know, peer support, peer pressure, positive peer pressure, that sort of thing. But this notion of patience, discipline, having so to speak, an eye on the ball, reaching out there for the best companies and the best industries, buying them when they're on sale, when their returns are high, forecast returns are high, and all that stuff applies here. It actually applies to either portable or individual investors also, and taking care of a portfolio. This is what we're going to talk about here for the next 45 to 50 minutes. Successful long-term investing in this environment, and this notion of basically portfolio design. What are the key aspects of building a portfolio? Second of all, and this is going to be most applicable to most of us in the room right now, how do you take care of them once you got them? And management does not come down to just keeping track of the prices. It doesn't come down to just reading the news on Yahoo Finance. There's more stuff to that. We're going to get into the best practices. But what I generally tell audiences when I make these presentations, especially true in person when we have relative newcomers in the audience, is that really the challenge of long-term investing boils down to something no more complicated than a dipstick. And anybody in the room that's relatively new to this, I encourage them to think of investing as a long-term journey. And any time you take a long-term journey, you want to focus on the things that really matter, like air in the tires, gasoline in the tank, in this case, oil on the dipstick. And literally you can identify the key characteristics or the key attributes of portfolios that we have to take care of, much in the same way that we keep the right amount of oil in the engines of our vehicles. And again, it's a matter of you can't have too little and you can't have too much. You got to be somewhere within a target range with again, a low limit and a high limit. And we can apply that same concept to our use of dashboards and to taking care of what really matters, what's really important when it comes to long-term investing and portfolio design and management. Let's talk for a second about the core holdings. They're going to make up the majority of most of our portfolios. Core holdings are those that we define as being up, straight, and parallel, consistent, stalwarts, blue chip type companies, where the top line and bottom line trends, again the top line being sales and revenues, the bottom line being the profits or earnings, basically behave themselves. They're fairly consistent and they're up and from left to right and headed north. And basically what we do, again, whether you're in a club, participating as a partner, or as an individual investor, we attempt to discover, study, and understand and assume ownership of high-quality industry leaders. We try to buy them when they're on sale. We try to accumulate them when they're on sale. And yes, there are times when we will sell them when they're the opposite of being on sale. Let's talk a little bit about how many. As you build out a portfolio, especially if you're a fairly new investor, again, you wouldn't pay too much attention to the portfolio aspect or the portfolio measurements until you have a number of stocks in the portfolio. In this case, the academics would tell us that, again, there's a certain amount of risk in any portfolios. If you define risk as the roller coaster, again, the bumpiness of the prices over time is how they're defining risk here. And that's what's graphed over here on the y-axis. Okay. Basically, if you have one stock, we know that the price fluctuations in a single stock can be quite massive. As you begin to bring an additional stock and basically put it all together into a collection of stocks, you kind of damp out those massive fluctuations. Some stocks zig when other stocks zag, that sort of thing. But you can never take away all the risk. I mean, all stocks follow the market to some extent, and there's nothing you can do about that, even if you were to hold 1,000 stocks. This is where our guideline kicks in. We basically think that as this curve starts to flatten out, you're doing the best that you possibly can, and it flattens out somewhere between 12 and 20, somewhere along here. And again, our experience has been that the more experienced investors might hold as few as 12 stocks. And again, most investment clubs are going to hold somewhere in that 12 to 20 range. And this is also valid for personal portfolios. If you're paying attention and keeping up to speed on your stocks, you could hold as few as 12 stocks. You wouldn't be really diversified according to the academics, but you'd certainly be focused. And if you want to read more on that subject, you can look up the works of Phil Fisher. It's something we spent some time on here at Manifest. And a few other of the legends who believed, including Warren Buffett, who believed that you should invest in what you know, and when you find something you know and believe in, it is all right to become somewhat concentrated in it, as long as you don't get carried away. What's the definition of carried away? We basically, as a general guideline, emphasis on the word guideline, suggest that you have your 12 to 20 stocks, somewhere in this range, and just make sure that no single position is dominant. The average position based on the number of stocks in the portfolio is probably going to be somewhere in the upper single digits range, somewhere in that 7 to 8% range. And as you can see, as you go more concentrated, it actually trails up. So literally the average position size, again, it's a function of how many stocks are in the portfolio. If you had a 12-stock portfolio, you basically would be more tolerant of a stock that was up if one single position had accounted for 20% of your total assets. That's less true as you get out to this end of the extreme. And basically our guideline is take the average position size. 2 times that position size is probably an upper limit. Again, just as a guideline, emphasis on the word guideline, and half a position size is probably a fairly decent minimum. In other words, you get down too much below, when the position gets too small, it just doesn't have enough impact on the overall results of your portfolio. So 12 to 20, and then again, depending on the number, some general position sizes for average positions. Prudent diversification, we think this is the most important form of diversification. You want to have enough small, medium, and large companies, and you want to have some of each, to be prudently diversified. We use growth as our measure of size. So basically we say you want a mix of faster growing companies, medium growth companies, and slower growing companies. Of course, the slower growing companies are going to be the larger blue chip companies. In this case, we're taking a look at again, proof positive. This is the graph looking at the last 10 years, starting with, that's a special code for S&P 500. The blue down here at the bottom is the S&P 500. Again, the S&P 500 is a collection of very large stocks. And if you look at where we were in 2001 versus where the decade ended up, that's what people refer to as the lost decade. If you were heavily concentrated in S&P 500 stocks for the last 10 years, chances are you're not very happy. You want to have smaller companies in your portfolio. This is my memory device, or my technique for remembering. It's a goldfish, and again, many of you have heard the story. If that goldfish stays in that fishbowl, that's as big as he's ever going to get. If he's able to jump out of that fishbowl and into a tributary or a river that's conducive to growth, he could literally become a 60 or 70 pound, 6 foot long monster. So if you can actually escape that, again, the memory device being small companies in the right growth environment can be pretty powerful things. So some of our smaller companies don't stay small companies. They become bigger companies just by succeeding. And that's kind of my memory device. To make that point, here's the Russell 2000. Now that's a small cap index, but the Russell 2000, if you had looked at just those, notice the differential in performance here. The Russell 2000, which is just small companies basically, outperformed the S&P 500, the large companies, fairly significantly over the last decade. And then last but not least, there's this intriguing green line. The green line is the Value Line Investment Survey Index built from the 1,700 companies. And the reason that this is important is it represents a mix of all of the above. The green literally is an all of the above situation. And notice that even beyond the small companies, what a tremendous differential or improvement in longer-term performance. In fact, if you've been following the teachings of the gurus and the legends we talk about around here for the last 10 years, you didn't have a lost decade. Let me repeat that. If you invested in enough slow-growing, medium growth, and fast-growing companies over the last 10 years, you did not experience a lost decade. And that's just critical in the context of portfolio design to know that you have to pay attention to that. Let's talk one last overall prevailing design characteristic, and that has to do with a little bit of asset allocation. As we'll talk about here in a few minutes, we do a program at Manifest Investing called Dashboard Diagnostics. It's a monthly program where we take a look at a club portfolio. A few months ago, we took a look at a club called the Plungers, and they were in the middle of a civil war. In fact, this 40-year-old investment club was very close to disbanding, and the civil war that was erupting was over this notion of the majority of the ladies within the club, and this is a fantastic investment club, they wanted to stick to the up, straight, and parallels, the cores, whereas some of the ladies in the club wanted to be a little bit more speculative or frisky, for lack of a better word. And we got to talking about the potential that you could literally divide your portfolio into two parts. Again, emphasis on the core, keeping the Johnson & Johnsons, the Procter & Gamble's, McDonald's, you fill in the names, Aflac, all of those make up that blue chip component. Obviously buying them high quality when they're on sale, but maintaining that core part is absolutely okay. But Nicholson also taught it was okay to pursue non-core stuff, which is what these ladies wanted to do. So giving them permission to do that, and by the way, they're just having a blast doing this now, where they actually have permission to pursue some different type of companies, whether they're emerging, maybe a company that's just barely beginning to have earnings, cyclical. Again, cyclical, not for beginners, but they're okay if you know what you're doing with them. They're more dangerous if you don't know what you're doing. Low growth, almost no growth in some cases. And then this notion of it being okay to accumulate cash if you can't find something when you go shopping. And again, that can be a very important capital preservation mode for individual investors following this stuff. Here's the guidelines straight from the NAIC manual from years ago. Again, basically saying that in this 25% section, if you can't find stocks to buy, stocks that don't appear to be on sale, and that could happen here in the next year or so, it's okay to take this 25% and have as much as 50 to 80% of it in cash equivalents. And by cash equivalents, we mean money markets. Cash could be there, or short-term bond funds. And in this case, that would be as much as 20% of your total assets in cash waiting for buying opportunities. I mean, think about that. If you take a look at Value Line, those of you that are Value Line enthusiasts, right now their asset allocation for cash is probably closer to 35 to 40%. I haven't looked lately, but it's actually up closer to 40% for cash equivalents. So this is not a completely foreign concept, but again, you wouldn't want to do this as a beginner. For beginners, we say stay fully invested. But once you've been at this for, let's say, 5 years or beyond, or you're comfortable in your investing skin, you can consider the selling a stock and hanging on to the cash or money market or whatever until opportunity presents itself. And again, think back over the years to the times when you rode the stock market down. You're sitting there with all kinds of shopping opportunities, and you have no cash. That's what Nicholson hated to see happen. Again, for an experienced investor, they can take advantage of this. But it is, again, let me be crystal, you can simply focus on the core. You'll be fine. You may be sacrificing a little bit of an incremental return, and it obviously requires a little bit more effort to pay attention to this concept. But one that I would encourage all experienced investors to consider and decide for themselves whether or not it's something they might want to do.
Hey, Mark.
Yep, go ahead.
We had a question on where in Value Line you find information on cash equivalents.
Okay, in Value Line on their summary, their weekly summary page, I don't know the name of it. We'll go take a look. Let me make a note to come back to that when we switch off here. They actually have a page of recommended asset allocations. And we'll go take a look at that at the end when we wrap up the PowerPoint. Anything else, Kurt?
Nope.
Let's jump to Value Line and take a look if we can. All right, so let's talk a little bit about our monthly sessions known as Dashboard Diagnostics. This particular club that we talked about just approximately a week ago. The name of the club is Mad Loot. They're out in New Jersey. We had a lot of fun with this one, and we talked about The Sopranos, the HBO award-winning show, and come to find out the club was actually in the neighborhood of The Sopranos. Kind of funny. But in this session that we have for portfolio design and management, this Dashboard Diagnostics, this is literally how we take a look at virtually any portfolio. For the program every month, we generally take a club and we delve into it for stories or lessons or that sort of thing, basically treating it as if it were our own. What would we do with it? In this case, here's the portfolio. And by the way, this is kind of what I see when I look at one of our dashboards, especially when I'm in the mode of sitting there thinking, what do I need to do? And in this case, I've chopped out a few of the columns, and I'm literally focusing in on these three main portfolio characteristics of growth, quality, and projected return. We're going to spend some time talking about these three. My eye literally goes to all three of these, and I'm literally gauging them to decide what needs to be done. In the case of Mad Loot from last week, literally the growth is fine. We want to be in that 11% give or take. Quality, as it is with most investment club or better investing influence clubs, just fine. And all we needed is a little bit more return to basically get it up into our target range. So that's what I see. A couple other things that we talked about, we're just talking about. Well, how much is too much? Well, Apple's position size at over a quarter of the portfolio, that's getting a little bit hefty. So they might want to look at opportunities to do some weeding there. And in this case, they had only begun accumulating AmTrust Financial Services, so that's why it's down at a relatively small 2% of total assets, part of the portfolio. The other thing is we challenge the companies at the bottom that have the lowest projected returns. Again, this final column on here has been sorted by projected return, the return forecast descending. So potential selling opportunities are at the bottom. So potential selling opportunities are down here. Potential buying opportunities are up here. And literally that's what we think of as we're thinking about how do we raise the overall portfolio return forecast. And one of the ways would be to, well, first of all, deploy the cash if we can find something that makes sense. But the other way is to basically take a stock like Hibbett Sporting Goods and replace it with something with higher return either from within the portfolio. In this case, this would be a strong candidate because of the position size and these factors right here. Replace Hibbett with some AmTrust and perhaps go outside the portfolio, do a little bit of shopping. So let's kind of walk through these. Here's the first one. Here's the portfolio on the left. The projected return of the overall portfolio is 11.2. Our target range is 5 to 10 percentage points above the general market, which right now is basically at 7 to 8%. So we basically would want to target a 5 to 10 percentage point advantage to the market. That's what's depicted right here. And you can see they're just a tiny bit short. So again, the objective becomes close that gap if we can without messing up the portfolio. Again, challenge the ones at the bottom after it's been sorted by projected return. That's exactly how we handle Tin Cup every month. These up here at the top, now I noticed that these are very high quality, so that makes me feel a little bit better. But anytime you get too good to be true, potentially too good to be true returns or nosebleed type of returns, it can be a situation, especially for lower quality companies, where there are other shoes yet to drop. So that's what we're talking about here. It could literally be a case where the analysts are not yet they haven't caught up to some of the shifts and changes in the fundamentals for the company. Second most important characteristic, quality. Never a problem, let me say rarely a problem with a better investing influenced group. The nutshell version is right here. The reason that we care so much about quality is that it's kind of an insurance policy during bear markets, recessions, and deep corrections. And just as a reminder of how powerful this can be, you can see this graph up here at the top. This is literally from the teeth of that most recent gruesome bear market that happened. I basically took a collection of the lowest quality companies at the time, and basically the average returns were a negative 60% annualized drop for these companies. In fact, there's 2 or 3 companies from this group that actually went out of business, so it was actually worse than that. And the moral of the story here is if you do stick to the higher quality companies, again, all of these color-coded in blue are excellent, they only went down in that same time frame roughly 15%. While the stock market average was down 40%, the higher quality companies went down 15%. The really weak quality companies went down like 60%. The average was 40%. And again, the message is they're going to protect you. They're going to, basically almost all stocks go down, but the higher quality companies go down less. When we hear somebody talk about the defensive companies, many times the higher quality companies are the the ones they're talking about, the flight to quality, that kind of stuff. That's the reason that this is a very natural phenomenon. We like to see somewhere in the 75, give or take. There's no scientific answer to this. Roughly a quality rating of 75, give or take a few points, is going to be the type of portfolio that is kept out of trouble during some of the nastiest excursions out there. And the third, and this is one of the most important portfolio design aspects, that, as we talked about a few minutes ago with the lost decade, this portfolio is fine at 11.5%. It's right in the target range as is shown here. And the portfolio is distributed amongst small, medium, and large. Again, faster growing small companies, slower growing large companies. You don't have to obsess over this other than to make sure that the pie is distributed and that you're not completely concentrated in any one neighborhood. So this one's in pretty good shape. All right, let's talk a little bit about best practices. In this case, our first suggestion is keep score. And if you're using the Bivio Club Accounting software or the other software available through the National Association, you have an opportunity to benchmark your performance against a variety of things. It really doesn't matter so much what you use. In this case, we're talking about the S&P 500 using an index fund based on the S&P 500. And this particular club is the model club run by the Mid-Michigan chapter of the National Association. And we're basically talking about a period from February 2003 out to, in this case, we chopped it off at 2011. And here's what we're talking about. A return of 10.7 versus 5.5. So literally the relative return of this investment club is 5.2. 10.7 minus 5.5. So the relative return is 5.2% better than the benchmark. That's huge. That's absolutely huge over the long term. If you can maintain that, that's going to lead to rather dramatic long-term results. And it is okay to have strong results and fun. Let's put that in context. Some of you saw the beginnings of this morning. Long-term performance in terms of this notion of relative return. Relative return, again, comparing versus the market over the period we're talking about. Just to give some context to the numbers, Fidelity Magellan from 1977 through 1990 had a relative return of 13. That, by the way, that's the best we've encountered with a couple of smaller examples. That's what we're looking at right here. So over a period of 13 years when Peter Lynch ran the Fidelity Magellan Fund, we're talking about returns approaching 14% per year. The BL is Beardstown Ladies. They actually checked in at a positive relative return for the period 1983 through 1997. Warren Buffett and the Berkshire Hathaway gang, again, checking in at a relative return of 6.6, and that's over a period of 20 years, going back 20 years. So that's a 6.6 percentage point advantage to the market over 20 years. Again, putting in context, 5.2% over a period of approximately 8 or 9 years for the Mid-Michigan Model Club brings us to this point right here. And for me, what is kind of a fascinating slide, what we've graphed here is a number of sample points. The red ones are institutions, either equity mutual funds or some type of professional fund or index or whatever. The blue ones are investment community, long-term investing community related, either they're investment clubs or something along those lines. And could be in the case of Tin Cup at Manifest. Notice how strong Tin Cup has performed over the last 17 years. This was a participant, Rappahannock was one of our witness protection program participants in Dashboard Diagnostics a couple of months ago. And they were actually quite depressed about their performance level at the time, you know, and put in this context, pretty strong. Another local model club out of Brighton, very strong results. There's that Mid-Michigan club. Here's another club from this area that's, again, keep score. Relative performance is very strong. Here's the club we featured last week for Dashboard Diagnostics, Mad Loot. And interposed in all of this is a few more of the more widely held or mutual funds with a high level of total assets. Now, I could put in a whole bunch of red dots. If we basically went out and randomly selected a bunch of professionally managed funds, what you would find is just a whole bunch of red dots down here, guys, all over the place. Literally, for every red dot that you see up here, you could find in a scientific sample 8 or 9 that are down here sub-zero. It's just a fact. So kind of put that in context and notice where those blue dots are, and we're going to be spending a little bit more time talking about those blue dots in the future. By the way, the Mutual Club of Detroit over that 60-year time frame checks in at plus 3.4. Again, I mean, that's out here and up here. Pretty good stuff. Then one last thing I'll draw your attention to, here's that value line arithmetic indicator. Notice that over the last 25 years, just investing in all of the above, small, medium, and large, and this is fascinating to me, small, medium, and large, doing nothing else, beat the general market benchmark, Wilshire 5000, S&P 500, however you want to measure it, by 3.4%. It's almost indefensible. If you're in a club that's not investing in small, medium, and large, including some faster growing companies in the mix, you're basically giving this up. This is how important this is. So I find that slide fascinating. We could probably spend a half hour talking about that slide and throwing a few more points on it, but I think it's pretty cool stuff, and I'm just completely excited, intrigued, excited, all of the above about where all the blue dots are ending up. Now, I'm not saying for even a heartbeat that there aren't a few blue dots down here. In fact, right now, just 2 years in, we could put a blue dot right here for the roundtable. We have a roundtable session coming up on Monday night. I guess my message there is anything in this time frame, if we're talking about, again, if you're relatively new to this stuff, if you're out in this 4 years or less time frame, don't pay a lot of attention to the performance over here. Just don't. Give it some time to gel. I fully expect the roundtable over time to drift up here. Now, they might ask me to stop picking stocks in order to do that, but time will tell. All right, other best practices. Again, be shareholders, be stock watchers. Those of you who do use stock watchers within investment clubs, although we would argue everybody in a club should really be looking at the big picture of the overall portfolio. It's okay for some of the partners to focus in on a given stock. Let's talk a little bit about opportunities and threats, and something we do at Manifest Investing that's a little bit different. Many of you have already heard this story, but what you see there is basically door number 1 and door number 2. Not exactly a fair fight. If you were shopping for opportunity, the visual analysis for the company on the left is far superior to the one on the right. And many of you already know that this is a trick question because they're the same company. The difference is the same company analysis performed on the same day. On the same day, the only difference is at Manifest, we include a couple of years of analyst estimates in the mix. So literally, in this situation, this trend had already been disrupted. Again, these are performed on the same day. Look where the earnings forecasts are. If we know price follows earnings, and they do, the stock price here was in serious jeopardy. On the traditional guide, that is not reflected yet. And literally what we're looking for any company as we do this is inflections, threats or opportunities, either direction, up or down, as the quarterly results come in and the analyst consensus estimates for the next year and the year beyond are factored into the equation. We're always looking for, again, the opportunities from favorable change and the threat of a negative change. Now, again, this company is Pulte Homes. It was part of the home builder depression. So a little bit of a special case, but again, the traditional guide did not see the price downdraft coming. By the time you would have seen this, your stock price was already down, I kid you not, 80%. And this is basically the answer to one of those questions. How come my stock selection guide just keeps looking better and better and better? And the answer is you really have to factor in the analyst expectations for the next couple of years into the formation of this longer term trend. Here's an example. In fact, Mary and I were talking about this a little bit before things got started. We monitor this stuff, and as a shareholder or a stock watcher, you really should be monitoring this kind of stuff. In this case, Stryker, and again, there's no major changes going on here, but what we would be watching for, what we would be vigilant for, is any major changes in the analyst forecasts for next year and the year beyond, and if those shift over time in a fairly dramatic fashion, again, either up or down, but in this case, we'd be looking for, a potential downdraft or a degradation of this forecast, dragging this longer term trend down. As a stock watcher, you can watch for it. This is from the Finance Yahoo page for Stryker. Watch for these numbers to trail off. So watch the trend over the last quarter or month, and this is the area that we were talking about watching fairly carefully to see if there's an uptick in other words, an opportunity in Strayer. Again, watching these numbers, factoring them into the analysis that we do on given companies. Let's talk about another massive opportunity. A couple of years ago, I did a presentation with Steve Sanborn at one of our national conventions. The online stock study is still out there, where we talked about Coca-Cola over the years. And again, we're talking about a situation where the net margin for the company had basically been in single digits for quite some time. And then they went through a period where they owned part of CBS or one of the movie studios, and then they shed that right here. And if anybody wants to take a guess at where did Warren Buffett buy the company, he bought it right here, 10% of the company, because he had some vision of this cascading of improving profitability after they got rid of the movie studio, and the opportunities that they had to, as an example, take some of the metal out of their cans. Remember back when, like this can shown was fairly thick and actually quite heavy compared to what we have today. That's part of what's behind this improvement. So again, watching for a general company-specific or industry-specific opportunity for increasing or improving profitability, improving productivity, that sort of thing over time. Once you knew this was in place, and then you can begin watching for the plateau where the diminishing returns have to stop at some point. We're probably close to it or almost there at this point. They can only make those so thin. So this is an example of watching for a fairly massive opportunity. One of the things I would suggest as a homework assignment, I haven't done this yet, but one of the things I would suggest as a homework assignment is take a look at this picture with respect to railroads. I'll just put an RR down here as a reminder. I wonder what that picture looks like for railroads. And it might not be so coincidental that he bought the Burlington Northern. Best practices: be willing to sell. It's okay. Take advantage of selling opportunities. It's one of the ways you make your portfolio better over the long term. We only can think of 3 reasons that you ever would sell a stock. The first is very specific and personal. You need the money. And literally it comes down to, it could be a partner transferring out, or you're paying off a withdrawing partner. Literally, make sure that you audit the company studies, audit your dashboards, make sure that those returns make sense to you, and then select from the companies that have the lowest expected returns. In other words, the lowest return forecasts, very much like that challenge process. You see the word challenge right here that we talked about just a few slides ago. Second reason to sell, well, just like we were talking about opportunities and threats. The threat most often will come in an area like declining profit margins. Could be weird footnotes, could be slowing growth beyond what you had originally expected, could be changes in management. But at Manifest Investing, we simply watch using the Chronicle for material shifts in the quality of the companies. That can be reason enough to actually discard a company. And the third reason, and this is where Nicholson believed 80 to 90% of the decisions that you make with a portfolio, is because you can sell one stock with lower expected returns, replace it with a higher expected return stock, improving the expected return of the overall portfolio, maintaining quality, maintaining those target ranges we talked about, and basically staying prudently diversified. So that it basically comes down to be willing to sell when you can improve the portfolio in the process. So with that, we'll just basically close on our common ground. Again, these are some of the things that I think some of the more successful investment clubs, they coalesce around. When they're around the campfire with Woodstock and Snoopy, they're basically saying, we've got to have enough return, we've got to have enough growth in our portfolios, we want to maintain quality, and you can actually transcend or extrapolate this to your personal portfolios, again, based on who you are, how you might handle particular questions or challenges, how you would target things like dividends, overall growth, all that kind of stuff. It really is a function of who you are, your attitude towards real risk, your time horizon, whether or not you've reached critical mass, all those things come into it. But make sure that you stay attentive and watchful for the promising companies. Monitor those target ranges. Again, think dipstick. If the oil is off the dipstick, you have to take action when you need to. And again, especially within the investment club environment, be vigilant for those threats and opportunities. Don't just read Finance Yahoo reports and say that you're following your company. You should be watching. You should be watching for shifts in financial strength, for example, profit margins, as we showed with Coca-Cola, all that kind of stuff. And again, whether as an individual investor or a member of a club, we heartily endorse the concept of discovery and having a fun time while you're doing it. So with that, I think we can open up the floor for any questions. We had the one about Value Line.
We have a few more questions along the way, but I'll let you get to that one first.
Okay, let me see if I can actually get there right now. I'm not even sure I can. I'm actually going into my Value Line subscription. I actually need to come in through summary and index, I think. Oh, hold
Laura
on.
says she found it on the Market Monitor page.
And I'm trying to figure out how to get to it without going to my normal Value Line because I'm on the wrong machine for that. Repeat that one more time, Kurt. It's towards the back of, I believe, this section.
It was called the Market Monitor page.
Yeah, here we go. And basically, you go into the selection and opinion page, and as Laura is saying, you got to drill down into it all the way towards the back. Often, I think it's on the very back page of this. Here we go. And here's where you see it: Value Line Asset Allocation Model. And again, this is for experienced people. Basically, what they're saying is have approximately as much as 30% in cash and treasury issues. I would just say 30% as not an unusual guideline. And you can see that's down from where it was previously. So again, depending on who you are, again, the reason we make that point is to point out that 20%, that portion of the non-core, it's not science fiction. And if you explore the realm of balanced investing, it's something we'll probably do an entire program on. Balanced investing and basically capital preservation and preserving assets. That's where this applies. So again, it's on the very back. I think that is the back page of the selection and opinion page over at Value Line. Thanks, Laura.
We had a question on the Coke slide suggesting that there was a year missing, 2011.
Oh yeah, that's because it was we actually made that presentation a couple years ago. So the forecast wasn't out yet. Yeah, so you can see this was actually was prepared back in 2010. So these were all, this was at the time was the 3 to 5 year forecast was here. So maybe I will update that to see if we have continued to show evidence of that plateau. Probably not a bad thing to do. I'm making a note. Look for it in the forum.
And sort of a follow-up to that, Laura was asking if there's any back testing to see if analyst estimates are accurate. And she sort of answered her own question, but perhaps you can follow up on that.
Yeah, we've wrestled with that. We've wrestled with that a lot in the history of the company and in my days at Better Investing. So we're talking about quite a long time. There's a lot of academic research on the accuracy of analyst work, and I guess our approach on this one, and this one makes people very uncomfortable, is it doesn't matter. It doesn't matter whether they're right or wrong. And that usually makes people that we have been with in our community quite uncomfortable, and that's okay. Be uncomfortable. But think about it. Take a step back, take a deep breath. It doesn't matter whether they're right or wrong, because what they think and what they publish and what they say out in the general public and to their clients, the clients of their brokerage firms, it affects the market. So, I mean, if somebody came out tomorrow, the analyst covering Coca-Cola and said, you know what, I think their earnings are going to drop 50%. It wouldn't matter whether they're right or wrong. The stock price is going down. And literally what there's no correlation with is that concept. I mean, literally, it really only matters what they think and what they say. And stock prices are going to follow those, because the investment community is always looking forward. And that's why we really think it's important to embed those estimates. If you want more on that subject, by the way, we have a lot of longtime subscribers, but I'll point you to it anyhow. If you go into the articles section for more discussion on that topic of it doesn't matter that the analysts are right, whether they're right or wrong, go into articles, click on cover stories, and then just kind of page down till you get to Oh Captain, My Captain. It was our cover story from April 2008, featuring our friend Robin Williams there, and the Dead Poet Society, and you can see that image is right there, where we actually talk about this notion of it doesn't matter whether the analysts are right or wrong. Their opinions and the things that they communicate to the investing world is what hammers away at our stocks. So that's what we would encourage people to kind of get their arms around. It's weird. It's absolutely weird, and it's contrary to what some of my colleagues and fellow educators teach. Any other quick questions, Kurt?
There is one more. We've got a question asking about GPN, saying the price has stagnated for the past several years. It's in the Manifest 40. It's expecting 20% sales growth. Has it been expecting 20% sales growth since 2008? And it hasn't followed through. Is that the...
I don't think it's in the Manifest 40, but I know it's a roundtable stock. Let's go take a quick look. I'll tell you where we'll look. Let's go first to Value Line. It was GPN, correct?
Correct.
Yeah, and in this case, we take a look at global payments, and in this case, it is one opinion, but you can see that the stock price has literally been kind of range-bound since almost 2006. I'm also noticing that the projected low total return forecast is dismal at 2. That's pretty ugly. When we go to Manifest, let's go ahead and see what we look at right now. Could be a case where the Value Line analyst is extremely pessimistic compared to the other guys, and that is the case here. If you actually do a detailed study and dig in to see what Morningstar expectations are and Standard & Poor's expectations, you'll probably find them to be much more favorable. In fact, we show a book value growth forecast of low double digits for the company. And this can be an example of a company. In other words, we're discounting the Value Line work a little bit and basically bowing to some of the other analysis. We can take a closer look at that one and dissect it in the forum if you would like. Might be worthwhile to take a closer look at that. Just for kicks, I'll pull up a quick Value Line or a quick SSG. Pretty interesting. It'd be interesting to take a look at what some of that disruption is and what the analyst estimates are for 2012 and 2013. I'd probably be inclined to really focus in here on the last few years. And again, depending on what 2012 and 2013 show, I could warm up to an 8 to 10% growth rate pretty easily for the company. I'll make a note to take a closer look at that. Any follow-up to that, Kurt?
No follow-up, just one comment that says, I'm sure you mean that analyst estimates drive the stock price in the short term, but earnings drive the price in the long term.
Well, they certainly do. Yeah, over the long term, like I said, it doesn't matter who's right, but ultimately it's going to follow those earnings. That's why we like it when situations like bioreference labs behave themselves. And by the way, let me expand on that, because I wrote a series of articles almost 10 years ago on the subject. The actual numbers and research and the data that is used by analysts, that stuff is usually pretty good. Where it really begins to fall apart, and sometimes there's actually no resemblance between their numerical work and what the firm actually puts out as buy, sell, and hold. And that's where it really falls apart. When you can have a company that, according to the fundamental data, which is generally quite good, especially when it comes to industry studies and that sort of stuff, oftentimes there's no connection between that data and the words that they spew as far as advice. That's why it's so fascinating. There are so many people out there that pay so much attention to the world of buy, sell, and hold. That is where the big there's just a lot of nonsense there. I'll just leave it at that. Here's part of the problem, by the way, for GPN. Depending on what the analyst expectations are for profitability, it's been on quite a swoon for the last couple of years. So again, that would be interesting to take a closer look at that and see what the analysts think. And it looks like Value Line is forecasting at least more of the same. So it could be fun to look at that one. Any other questions?
Our questions are clear for this one.
Okay. I'll leave that one up for a few minutes. Let's go ahead and shut down. We'll stick around for a few minutes.